Happy Friday, everyone. And look, I'm not usually one to check the horoscope, but it is Friday the 13th, February 2026.
Uh-oh.
Yeah, and depending on your superstition level, that's either a reason to hide under the covers or just another day. But then I looked at the economic data that dropped this morning.
And you had to ask.
I genuinely had to ask, is this an unlucky day for the global economy? Or are we, finally turning a corner?
It's definitely not a day for superstitious dread, but it is a day for, let's call it complex reality.
Yeah,
We have a massive stack of sources today.
we really do.
We're looking at fresh CPI numbers, some incredibly dense and honestly kind of alarming Federal Reserve research notes, plus a reality check from the venture capital world.
It's such a weird mix, and our mission really is to connect these dots.
Yeah.
We need to figure out the relationship between these new inflation numbers, the baffling behavior of Treasury yields, and why AI startups are suddenly obsessed with sewage sensors. Because there's this narrative of a soft landing we've been hearing about for, 2 years now. But looking at this stack, I'm starting to wonder if we're looking at a no landing.
That is the big risk lurking in the background. A no-landing scenario where the economy just refuses to cool down. Growth stays hot, but inflation gets stuck above target.
Which sounds good on paper. I mean, who doesn't like growth?
But it puts the Federal Reserve in a terrible, terrible position.
Right, because if the plane doesn't land, it runs out of fuel eventually. So here is the roadmap for this deep dive. We are going to start with the macro inflation and the Fed's internal civil war.
Then we're going to tackle a genuine mystery, why borrowing costs are going up even though the Fed is cutting rates.
We'll see why that's freezing the 2026 housing market. And finally, we'll look at what's being called the industrial phase of the AI revolution.
Let's get into it.
Okay, let's start with the headline. The Consumer Price Index, or CPI, for January 2026 dropped today. Lay it on me.
The headline number is 2.4%. That represents the annual inflation rate.
Okay.
It's down from 2.7% in December, which is the lowest level we've seen since last May. So on the surface, that looks like a win.
2.4% feels tantalizingly close to that magical 2% target the Fed has been chasing for years. So are we popping the champagne?
I'd hold the cork. When you look under the hood, the engine is making some funny noises. The main reason for that drop was energy. Gasoline prices fell about 7.5%. Fuel oil was down significantly. That pulls the headline number down beautifully.
But we don't buy gas every single minute of the day.
Exactly. The stuff that hits people's wallets constantly, food and shelter, is still incredibly sticky.
This is the disconnect I feel when I go to the grocery store. The news says inflation is down, but my bill is up.
That's it, exactly. Food inflation actually ticked up slightly to 3.1%, and shelter, which is the biggest chunk of most people's budget, is sitting at 3%.
So you have this bifurcated economy. Goods that can be shipped, like energy, are getting cheaper, but services, rent, food...
You're just refusing to budge.
So gas is cheaper, but my rent and groceries are still climbing faster than the Fed would like. That feels like a trap.
It creates a massive dilemma. The Fed has been cutting rates to try and, stick this landing. Since September 2024, they've cut the federal funds rate by 175 basis points. We are currently sitting in a range of 3.50% to 3.75%.
Which is significantly lower than the peak. But clearly, looking at the minutes and the speeches, not everyone at the Fed thinks this is a good idea anymore.
No, the consensus is fracturing. We have a speech here from Kansas City Fed President Jeff Schmidt. He's kind of becoming the face of the hawks. He voted to hold rates steady in January, didn't want to cut at all. His argument is simple. Demand is still outpacing supply.
So, meaning people are still buying too much stuff.
Meaning the economy is just too hot.
Yeah.
He's worried that if they keep cutting rates just to be nice, inflation isn't going to gently glide to 2%.
It's going to get stuck.
It's going to get stuck at 3% forever. He basically said that price shocks become permanent based on what the Fed does. If they ease up too soon, they validate that higher inflation baseline.
And that ties into what I'm seeing in some of these online economic forums. There's a thread we pulled from Reddit where users are debating this no landing risk. It's not just an academic concept.
Not anymore.
If GDP is holding up and unemployment is low, but inflation stays at 3%, the Fed might have to slam on the brakes again.
And that's the nightmare scenario. If they have to hike rates again after cutting them, it just destroys their credibility. And to add a massive layer of uncertainty, we have the personnel drama.
Right. Fed Chair Jerome Powell's term expires on May 15th of this year.
The clock is ticking. And President Trump has nominated Kevin Warsh to replace him. Now, Warsh is generally viewed as more hawkish someone who prioritizes fighting inflation over stimulating growth.
So if you're a business owner trying to plan for late 2026, you have no idea if the playbook is about to be thrown out the window.
Total uncertainty.
So we have sticky inflation, a divided Fed, and a potential leadership change that could flip the strategy upside down. But here is where I want to pause and really dig in because this next part drives me crazy.
Okay.
The Fed has been cutting short-term rates. Logic dictates that borrowing costs should go down. But long-term rates, like the 10-year Treasury yield, are going up. They're hovering around 4.3%. Why?
This is the Treasury mystery. And honestly, this is the most important story in the global economy right now. We pulled a research note from the Federal Reserve Board, the Fed ES notes.
So the Fed themselves are trying to figure this out.
Even the Fed is trying to figure it out. The title is literally, Why Have Far-Forward Nominal Treasury Rates Increased So Much?
Okay, so what's the verdict? Is it just that people expect inflation to come back?
Surprisingly, no. They found that long-term inflation expectations are actually pretty stable. The culprit is something technically called far-forward real risk premiums.
Okay, stop. That sounds like jargon designed to confuse me. Far forward real risk premium. Break that down.
Think of it like car insurance. Usually, your premium is based on how much you drive. That's the interest rate for the time you lend money.
Right.
But imagine if the insurance company suddenly said, we're raising your rates not because you're driving more, but because we think the roads are going to collapse in 5 years, and also we think the car manufacturer, the government, is going bankrupt.
So it's a danger tax.
Perfectly put.
Yeah.
It's a danger tax. Investors are demanding extra compensation to hold long-term government debt because of two specific fears. The first is supply shocks.
Like what we saw in 2020.
Yes, for decades, supply chains were boring. Now, investors are terrified that we've entered an era of chaos wars, pandemics, trade bans that can break the supply chain at any moment.
And that causes inflation to spike and growth to tank at the same time.
A terrible environment for bonds. So investors want to be paid more to take that risk.
And the second fear.
Debt sustainability.
The national debt. We always hear politicians talk about it, but does the market actually care?
They care now. The Congressional Budget Office projections show the debt-to-GDP ratio reaching nearly 120% in 10 years. That is World War II levels, but without a war to justify it.
Wow.
The bond market is looking at the U.S. government and saying, you are borrowing so much money that we are genuinely worried about your ability to manage it without devaluing the currency.
And this creates a feedback loop, doesn't it? Because if the rates go up, the debt gets more expensive.
It's a vicious cycle. If investors worry the debt is unsustainable, they demand higher yields, that danger tax. But higher yields make the debt more expensive to service. The U.S. government has to pay more interest, which increases the deficit.
Which makes the debt even less sustainable.
Exactly.
So let me get this straight. Even if the Fed cuts the overnight rate to zero, even if they go negative, if the bond market is terrified of the national debt, the 10-year yield stays high.
That is the reality. The Fed controls the short end of the curve, the overnight money. But the bond vigilantes control the long end. And right now, they are staging a protest.
Which brings us directly to the housing market. Because if I'm listening to this and I want to buy a house in 2026, I don't care about the overnight rate. I care about the 30-year fixed mortgage.
And that tracks the 10-year Treasury.
Correct. And this is why the housing market feels so stuck.
Stuck is an understatement.
What are the numbers right now?
According to Freddie Mac, the 30-year fixed is steady at about 6.11%. The 15-year is around 5.50%. Now, historically, 6% is normal.
Right.
But psychologically, after the era of 3%, it just feels punitive.
It's not just the buyers, though, right? This goes back to that lock-in effect we've touched on before. If I have a 3% mortgage from 2021, I am not selling my house to go buy a new one at 6%.
That is the golden handcuffs problem. It has decimated inventory. The report from Nadlin Capital points out that while rates have stabilized, the turnover in the housing market is historically low.
There's no supply.
We aren't seeing a crash in prices because there's no supply. Sellers are on strike.
So we have high rates, but high prices. The worst of both worlds. I did see that President Trump has a proposal to try and force those rates down through Fannie Mae and Freddie Mac.
Yes, the proposal is to have the government-backed enterprises buy billions of dollars in mortgage bonds. The theory is basic supply and demand. If you create massive artificial demand for these bonds, the yields will fall and mortgage rates will follow.
It sounds like a cheat code. Can it work?
The economists at Realtor.com are extremely skeptical. Here's the problem. The mortgage market is massive. We're talking trillions of dollars.
Right.
For the government to move the needle, they would have to buy an astronomical amount of bonds continuously. It's like trying to empty a swimming pool with a bucket.
And if the underlying reason rates are high is that danger tax regarding the national debt.
Then having the government borrow more money to buy mortgage bonds might actually backfire. It increases the debt, which scares the bond market, which raises the yields.
You can't borrow your way out of a debt crisis.
You can't.
So the takeaway for the listener hoping for a return to 3% or 4% rates in 2026.
Don't build your life plan around it. I mean, the consensus for 2026 is that 6% is the new baseline. The spread between treasuries and mortgages is normalizing, which is good, but the floor has been raised.
Okay, so the macro picture is tough. Money is expensive, the debt is scary, and housing is frozen. Let's pivot to where the money is actually moving, the innovation engine.
Right.
Because if capital is this expensive, you can't just throw money at bad ideas anymore.
That's the key transition. High interest rates are a filter. They kill off the weak companies. And that brings us to what venture capitalists are calling the industrial phase of AI.
Industrial phase. It sounds heavy. It sounds serious.
It is serious. We're done with the party phase. The NASDAQ has actually been down recently, and software stocks are retreating. But there was a specific news item this week that really highlights why. An AI firm called Anthropic released a new automation tool specifically designed for legal work.
I saw this. It's not just, here's a template. It's, we can do the research.
Exactly. And look at the market reaction. Stocks like Thomson Reuters and Intuit companies that make their money on professional services and tax legal software dropped. Sharp drops.
Wait, hold on. We've heard AI is disrupting everything for 3 years. Every quarter someone says, this is the end of lawyers. Is this actually showing up in the earnings, or is this just another hype cycle?
That's the difference with the industrial phase. It's no longer theoretical. Companies are cutting spending on legacy software and human services because the AI tools are finally good enough to replace them. That's why those stocks dropped. Investors see the revenue disappearing.
So if you're a startup founder in 2026, the game has changed. You can't just have a cool demo.
No. We have a great breakdown from Startup Stash on this. In 2021, you could raise $10 million on a slide deck. Today, investors demand margins, cash flow visibility, and operational endurance. They want to know how you survive if the economy doesn't land.
And this connects to the no landing concept too, doesn't it?
Perfectly. If we have a no landing scenario, inflation stays high. That means wages stay high. Hiring humans is incredibly expensive.
So startups have to use AI to automate.
Not just because it's cool, but because they can't afford the payroll.
That forces efficiency.
It does. And we have a transcript from a panel at Startup Boston featuring Vivjan Murdo from Hyperplane. He calls this Chapter 2 of the AI revolution.
What was Chapter 1?
Chapter 1 was infrastructure, building the large language models, the GPTs, the Claudes, and the massive data centers. That was the build the railroad phase.
And Chapter 2 is?
Vertical AI.
Give me an example. What does vertical AI look like?
It's unsexy, it's boring, and it's profitable. Murdo talks about solving specific, tangible problems. He mentions sensors and sewage systems to track health data for cities.
Sewage sensors. We went from AI will write poetry to AI will watch the sewers.
But think about the value. A city will pay for that data every single month. It's a real business. The industrial phase isn't about the shiny object. It's about the useful object. He also mentioned a shift toward small language models.
Which is the opposite of the bigger is better trend we saw with Google and OpenAI.
Right. If you're a law firm, you don't need a model that knows the history of the Roman Empire and how to write a haiku. You need a model that knows your case files, is totally private, and costs pennies to run.
That's the shift.
Startups are building small, secure, domain-specific tools.
So the companies are getting real. What about the exit? Because for a while there, the IPO market was dead. Are these companies actually going public?
The IPO market is thawing, but it looks different. The Wellington Management Outlook calls this the era of the down round IPO.
That sounds like failure. Down round implies you're worth less than you were before.
It hurts the ego, sure. But think of it like selling your house. In 2021, Zillow might have told you your house was worth $1 million. Today, the real buyers are offering $700,000.
A down round IPO is the founders finally admitting, okay, the market has spoken, we'll take the $700.
It's a healthy reset. And the data shows that companies swallowing this pill are actually trading up after they list. Investors are willing to buy, but only at realistic 2026 prices, not fantasy 2021 prices.
And for the employees stuck with stock options who can't wait for an IPO.
That's where the secondaries market comes in. The report mentions that secondary markets selling shares to private investors before an IPO have hit over $210 billion in volume. It's becoming a standard liquidity tool.
So let's try to pull this whole picture together. We have a macro environment where the last mile of inflation is brutal.
We have a bond market that is effectively protesting the national debt, keeping rates high.
And we have a tech sector that has been forced to grow up and get efficient.
I think the unifying theme is the end of easy. The economy has moved from a speculative phase fueled by cheap money to a disciplined phase.
The free lunch is over.
Exactly. If you're a home buyer, you have to accept 6%. If you're a founder, you have to show profit. If you're the Fed, you have to accept that you can't control the long-term rates anymore.
That last point is the one I want to leave the listener with, because we talked about that Fed research note regarding debt sustainability.
This is the provocative thought for the weekend. We grew up thinking the Federal Reserve is the steering wheel of the economy. They raise rates, economy slows. They cut rates, economy speeds up.
But if the bond market is driving,
If the bond market is keeping rates high because of fiscal policy, because the government spends too much, then the Fed has lost the steering wheel.
so we might be entering an era where Congress, not the Fed, dictates your mortgage rate.
And if the debt keeps growing, the Fed might be just a passenger in the car, tapping the brakes while the car speeds downhill.
That is a sobering thought. Fiscal dominance. The bond vigilantes are back in charge.
Indeed.
Well, on that cheerful note, we're going to wrap it up. Good luck with your Zillow scrolling, and maybe check the price of sewage sensors while you're at it. That's all for this week's Deep Dive. We'll catch you next time.